Ladies and gentlemen, good day and welcome to Cholamandalam Investment and Finance Company Limited's Q3 FY22 earnings conference call hosted by Kotak Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Nischint Chawathe from Kotak Securities Limited. Thank you, and over to you, sir.
Good morning, everyone. Welcome to the earnings conference call of Cholamandalam Investment and Finance Company Limited. To discuss the 3Q FY22 performance of Chola and share industry and business updates, we have with us today Mr. Vellayan Subbiah, Chairman and Non-Executive Director, Mr. Ravindra Kundu, Executive Director, Mr. Shaji Varghese, President, Housing Finance, Mr. Suresh Kumar S, Senior Vice President and Business Head, LAP and SME, and Mr. Arul Selvan, President and CFO. I would now like to hand over the call to Vellayan for his opening comments.
Thank you, Nischint. Good morning, everybody, and welcome to the earnings call for the third quarter. Just some key financial results and highlights. Disbursements for the quarter were at 10,430 crores, which was up by 32%. And Y to date, they are at 22,772 crores, which is up by 27%. The total AUM is at 79,161 crores, which is up 4% year on year. The NIM is up at 1,484 crores for the quarter, which is up 9% year on year, and 4,240 crores for year to date 2021, which is up 18% year on year. The profit after tax is at 524 crores for the quarter, which is up 28% year on year, and 1,457 crores for year to date, which is up 15%. Some quick highlights. The post the second wave of COVID, we've actually seen that economic activity has steadily been improving, especially in contact-intensive service industries, which were hard hit by the pandemic. Pent-up demand and the monsoon have further aided to a swift revival of the economy in Q3. And we've seen uptrend in basic economic indicators, tax collections, power, vehicle registration, highway tolls, and e-way bills. And that all gives us a sense that this is going to be more broad-based in terms of the recovery. This in turn has led to a sharp recovery in both our disbursements and collections during Q3. The positive momentum seen in Q2 further accelerated during Q3 in terms, basically on account of healthy demand during the festive season and boosted auto sales and improved customer sentiment overall, right? And that led to a healthier demand for mortgage loans as well. In the last quarter, we also announced a new business division and business divisions and digital partnerships. So the 3 new business divisions are targeted at the consumer and SME ecosystem. One is consumer and small enterprise loans, and this division will offer personal and professional loans and micro and small enterprise loans through traditional direct-to-customer and digital partnership channels. To that end, we've entered into 3 strategic partnerships with leading fintech companies, Bank Bazaar, Credit Bee, and Paytail to scale up this business vertical. Second is the secured business and personal loans. So this division will offer loans to self-employed non-professionals through traditional channels for their day-to-day operations and capital investments. And the third is the SME loans, which will offer term loans, working capital finance, equipment finance, and supply chain finance to SME customers through, again, both traditional and digital channels. We also made an equity investment in PaySwiff, where we have entered into a strategic arrangement to acquire up to about 72% of the equity capital of PaySwiff Technologies Private Limited for a sum not exceeding 450 crores. And PaySwiff will consequently become a subsidiary of the company. PaySwiff is engaged in the business of enabling online payment gateway services for e-commerce and provides e-commerce solutions. PaySwift is an omni-channel payment transaction solution provider that lets business owners accept payments from their customers in-store, at-home deliveries, online, and on the go using their product offerings. The relationship is expected to add value to the existing Chola ecosystem by providing a platform to build new age SME offerings at scale, access to the SME network across the country, and an opportunity to be one of the preferred SME financiers. Next, I want to talk a little bit about the changes to RBI regulation on asset classification and provisioning under IRAC, which basically, as per their circular dated November 12th, 2021, this is probably the most significant change from RBI in this last quarter. Basis this, the following are the key changes brought into scope and into immediate effect. NPA evaluation will be on a day-to-day basis, on a daily basis, based on daily DPD runs after the end of the day process in the system. Agreements which cross 90 days DPD should continue to be classified as NPA until all dues towards principal and interest are completed. While these changes are regarding evaluation of NPA as per income recognition and asset classification and provisioning, IRAC-P as defined by RBI, and has no bearing directly on the ECL model, we have made suitable changes in presenting the stage-wise asset categorization to bring in more transparency in our reporting to enable all stakeholders to relate to figures both under the IRAC model and the Ind AS ECL model. Accordingly, we have subcategorized the stages as follows. We now have stage 1, stage 1A, stage 1B, and stage 2, stage 2A and 2B. So stage 1 total is the summation of those three, stage 1, stage 1A, stage 1B. Stage 2 is 2A, 2A and 2B combined. And then we have stage 3 and stage 3 legal. I'll just talk a bit about what each of these subclassifications are. Stage 1 represents assets which have never touched NPA and currently is within 0 to 30 days and hence not an NPA as per RBI norms. Stage 1A represents assets which had been an NPA in the past but are normalized and currently in the 0 to 30 day bucket. So it's hence no more an NPA as per RBI norms. Stage 1B represents assets which have been an NPA in the past but are yet to be fully normalized, though it is moved to stage 1 currently, and hence this will be an NPA as per current RBI norms. Similarly with stage 2, 2A and 2B, 2 will be assets that have never touched NPA and have always been in 0 to 90, so therefore they will not be an NPA per RBI norms, current RBI norms. 2A will be assets which had been an NPA in the past but have now normalized in the have been normalized post but are now in the 31 to 90 day bucket, and hence they're no more an NPA as per RBI norms. And stage 2B will be assets that have been NPA in the past and yet to be fully normalized, though it's moved to stage 2 currently, and hence these will be treated as an NPA as per current RBI norms. And stage 3 will represent assets which continue to be an NPA as on the closing dates, and these are obviously an NPA under RBI norms. So I think most of you should have received the press release by now, but we've got detailed figures as to what the totals are in each of those stages, and that will give you a much better and more transparent view as to what the overall implications for NPAs are. During the quarter, the company also made additional provisions of 136 crores towards management overlay, taking the total management overlay to 836 crores. I've been through the overall performance highlights. In aggregate disbursements in Q3 were at 10,430 crores, which is a growth of 32%. And I'll just go through the individual businesses. Vehicle finance disbursements were 7,647 crores, as against 6,084 in Q3 FY21, which is a growth of 26%. And year-to-date, December 2021, they were at 16,654 crores, as against 14,096 in the previous year, which is a growth of 18% year-on-year. LAP was dispersed 1,763 crores in Q3, as against 1,265 crores in the same quarter last year, which is a growth of 39%. And disbursements year-to-date were at 3,884, which is a growth of 59%. Home loans disbursed 437 crores in Q3 as against 434, and disbursements year to date were 1,129, which is a growth of 12%. The total AUM is at 79,161 versus 75,813. And the PAT year to date is at 1457, and for the quarter is at 524. PBT ROA was at 3.8%, and for year to date for the quarter and year to date it's at 3.6, and that's against 3.1 and 3.4. And ROE is at 19.3 against 17.6. The company continues to hold a strong liquidity position with 6,317 crores as cash at the end of December, and then including 1,500 crores invested in GSEC, and it's a total liquidity position of 10,671, including undrawn sanction line. ALM is comfortable. We have no cumulative mismatches. And the company also, the board of directors has approved the payment of an interim dividend of 65%, which is 1.30 rupee per share. Asset quality, as I talked about earlier, stage 3 assets were at 5.8%, with a provision coverage of 38.8%, as against 6.16 at the end of September 2021, with a provision coverage of 36.45. The total provisions currently carried against the overall book is 4% against the normal overall provisions levels of 1.75%, which we carried pre-COVID. And as per the RBI norms for the November 12th circular, our GNPA will be at 8.53 and our NNPA will be at 5.76. And we carry 746 crores higher provisions under Ind AS versus IRAC. The capital adequacy of the company is at 19.8% as against regulatory requirement of 15, and our Tier 1 capital was at 16.8%. So let me stop with that, and then we'd be happy to turn it over to you for Q&A. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Riken Shah from Credit Suisse. Please go ahead.
Thank you for the opportunity. I have 4 questions. The first one is on the new business vertical launched recently. Would you please elaborate a bit more in detail about the typical customer profile, yield, tenure, and medium-term growth aspiration for each of these new business divisions that we have launched recently? Second, the strong disbursements that we saw also finally pick up in the growth in vehicle disbursements. Given the demand outlook from here, do you expect this strong momentum to continue over the medium term as well? Third is on the asset quality norms regarding the RBI circular. Wanted to check whether it was applied retrospectively or prospectively from 12th November onwards. And going ahead, how should one think about the credit cost? Would it require further management overlays every quarter? And the last one is some data keeping questions. Wanted the total outstanding restructured loan book split between the GS1 and 2, total ECLGS disbursements made until now, and the collection efficiencies for last 3 months. Thank you. That's all from mine.
Okay. My RAM is not that high. Arul, have you got all the questions?
Can I reply that new business, sir? Respond to that.
Yeah, Ravi, why don't you start with the new business and then we can talk. And
then disbursement on vehicle finance, and then
Arul, you can talk about the IRAC question November 12th and retrospectively. And then the last question also, then Arul, you can respond. We lost Arul here?
Sorry, sir. I was on mute. Yes.
Okay. So first, Ravi, why don't you answer on the new business and this thing?
Sure, sir. Sure. Good morning, all of you. Good morning. So, as the chairman mentioned some time back that we want to basically address this ecosystem of consumer and the SME. So I'll try to basically explain the business line, what we launched in line with that, past commitment to the public. So SME ecosystem, we are now starting from top of the bottom of the pyramid, which is a small grocery shop, general kirana restaurant, and that is a secured business loan. Will be based on the informal collateral, and that can be given to a small stationery shop, it can be given to medical shops, salon, electrical appliances, services, all those stuff. And it will be purely the tier 2, tier 3 town. It will be the ticket size will be around say 1 to 5 lakh rupees. Small ticket size, small loan. A small people who are starting their business, they have a residence stability, they have a business stability, that kind of business, and it's going to be good ROA. That's starting point of SME. The second point is going to be the professional and non-professional business loans, which is going to be given to a small self-employed customer who are running a little bigger than the customer who are going to be served by the secured business loan category. And third category is SME, which is a medium enterprises where we will be giving a term loan. So under the secured business line, the loan will be a plain term loan type, where will be EMI will be collected month on month, and it can be 2 to 4 years. And in the case of business loan, there are 3 types of business loan as of now in the market. One is the term loan, then there is a flexi loan, and within the flexi loan, we have a simple flexi, hybrid flexi, drop line flexi. So those are all the loans, and then subsequently we will start the credit line also. So whatever basically being offered in the business loan category in the market by the various competitors, various players, all of them, all will be done by us. And this will be done in 3 channels: D2C, direct to customer, and second is the traditional channel, which is DSA franchise channel, and third is the DST channel, where it will be generated and be served by the team member. So this is the SME, which is starting from top of the bottom of the pyramid to the middle of the pyramid and slightly upper segment of the not the large one, but it is the medium one. So that way we will basically cover entire SME spectrum. In the case of consumer, we are starting both professional loan and salaried loan, but the salaried loan will be small in terms of the percentage of the overall book, but professional loan, which is going to be catering to the doctors, engineers, and chartered accountant, and those professionals will be more. So around 70% will be of that of the mix of will be coming from there. Now coming to the SME, we will be giving 3 types of loan, and which is going to be a term loan, working capital, equipment loan, which is industrial equipment, and supply chain finance, both forward integration and backward integration of the anchor sitting in the center, and giving the channel funding and discounting on the bill of the vendors. So these are the products which we are as of now thought about it, but the market is dynamic, and we time to time we will review that. Whatever is going to be suitable for us, we will be doing it. As Chairman said, that it is important for leveraging the 1,100 branches, and going forward, whatever new locations are going to come, it will be easy for us to expand across the country very fast and use the traditional channel, and then move to the partnership channel, where the 3 partners have already been onboarded, and around 10 partners we are discussing with them, and mostly we are getting all digital lending being done in the market, and then those partners will be working with us, and both of us will be working in 3 types of tie-ups. One is the loan being collected by them, or loan originated by them, collected by us, and third is that end-to-end collection and underwriting will be done, and they will be doing origination. So this is what is the new business. As far as disbursement of vehicle finance is concerned, we have seen that we have been doing very well. This is because tier 2, tier 3 town, small commercial vehicle, light commercial vehicle, heavy commercial vehicle, and cars and MUV have started doing well. The highest growth has come from used vehicles, which has continued to grow. We are expecting that the growth momentum we gained in Q3, it is going to be continuous now, because we are seeing that the impact of wave 3 is slowing down now. Little impact came in the month of January, which is slowing down now, and we will start getting benefit from February. Hope I addressed the entire your business growth question.
And so, just on this, if you could also share any ballpark or typical yield profile for the new business verticals that we have launched, and what would be our medium-term growth aspiration for this?
Yeah. So yield we will not be able to disclose, but the ROA will be higher than the current ROA. That is one. And yield we don't disclose for the existing business as well. So the ROA, it looks like the ROA which we are going to target from the new business lines will significantly higher than what current levels are. And second is that it immediately from the Q4 itself, I'm expecting that we have done 10,000 crore disbursement. It will start adding from the new three business lines can be around 600 to 700. So 7-8% increase can come from the Q4 itself. And then subsequently as we expand it across the country, then the disbursement can be anything.
Okay, fine. That's helpful, sir.
Yeah. Sorry, this is Arun here. Can you hear me?
Yes, sir.
Yeah.
So this is on the question from Iraq. We started using the daily DPD from November 1st because, we had that data from November 1st and we have set the system capabilities from November 1st. Though the circular came from November 12th because we could do it from the 1st of November. Credit provisions, as of now, we don't see anything further going up, and as a matter of fact, there should be reversals. But we have to look out for how the COVID-3 pans out, shutdown pans out, etc. That we will have to see. You had another question on the restructuring. Currently, the total book is around 4,600 crores on the restructuring. Almost 4,000 crores of that is 4,300 crores of that is in stage 2 itself, which is where we have grouped the whole of this restructured book. Around 300 crores has moved to stage 3 because of some of them having some delinquencies starting to come in. On the ECGLS, during the current year, we have not done, we have done around 30 crores, 35 crores of disbursements. The opening book is around 2,000 crores, so that's the status on ECGLS.
And so when you say the restructured loan book 300 crore has moved into stage 3, so there is nothing.
Would request people to restrict to 2 questions, giving opportunity to others.
Yeah, because
just
time, we only have 1 hour today, so we can.
Sure. Just a clarification one. On the restructure, nothing is in the stage 1 book, right?
Stage 1 is grouped as stage 2 because though it is stage 1, we have grouped all of the 3,000 in stage 1 only. They are not having delinquencies of even 30 plus. But because they are restructured, we have considered them as a slightly higher risk and providing them with a higher levels of PD and LGD. That is why they are grouped under stage 2. Even though RBI does not mandate us to group them there.
Got it. Thank you. That's all.
Yeah.
Thank you. Before we take the next question, a reminder to the participants. Please limit your question to 2 per participants only. You may rejoin the question queue if you have a follow-up. The next question is from the line of Dhaval Kada from DSP Mutual Fund. Please go ahead.
Yeah, hi. Thanks for the opportunity. I had 2 questions. First was on the new verticals that we've announced. So, the question is, we made certain investments. We've, opened these 3 new verticals. Is there any, gap that is still to be bridged either via organic or inorganic, strategy? And overall, I think Ravi mentioned about 7-8% of disbursement coming from these verticals. In the next couple of years, would these be like 20% or more in terms of disbursement? Would that be the sort of momentum that we will look for? I mean, some color beyond 1 year, if you would provide. And the cost associated with these, is it already loaded? How much more can we expect from this? Yes, that's the question. Thanks.
Ravi, will you take it?
Yeah.
So, first question is what you're talking about to fill up the gap. As of now, we have already invested in the proceeds, and ecosystem of PaySwiff will provide us the access to MSME, wherein we can actually go to straight away 3 lakh customers they have. So we can actually talk to them what are their needs, and we can actually serve them from the lending point of view. And market is dynamic. As of now, we have not thought about it. The investment in PayTel and PaySwiff are giving opportunity to kind of expand our business from this level to the definitely. But it's just based on any opportunity. We will think about it. But it comes with the disbursement. As I mentioned that within say 6 months time, the run rate per quarter can be more than 1,000 crores from these businesses. As of now, we are doing say 10,000 crores from the 3 business lines which we have been doing for quite some time. And this 1,000 crores within next 2 years time can actually go up to more than 5,000 crore also. So it depends on how fast we expand it. Opportunity is humongous. We need to, as you have seen that in the past also, we do not jump into growing very fast. But then it looks like these 3 businesses are, in terms of execution and in terms of increasing the volumes are faster, because we have a opportunity coming from the partnership, opportunity coming from the traditional channel, and opportunity coming from the B2C channel, which all three are not available in the case of vehicle finance or LAP or home loan. So definitely the growth will be faster, but I don't want to give you any mix as of now. Let us actually wait. Quarter on quarter, we'll see. I'm expecting that these 3 businesses can start growing 1,000 crore per quarter type within 3 to 6 months time, and then we will discuss. But the opportunities are humongous, and it is going to be very fast as compared to the previous businesses.
And on cost, any color?
So cost is part and parcel of the business. As of now, whatever we have done, technologically, whatever investment have been done, we have already incorporated. And most of the cost in the technology side is basically, getting the technology companies for using their system, LOS, LMS, and SaaS model. So it is not CapEx but OpEx more. So therefore, the cost from the technology point is not one. This is the people cost. So we have already, incorporated the existing business plan itself. So, and it will be in line with the business as we grow business, and the businesses will see that branches. So the one important thing is that we need not worry about the infrastructure cost for expanding the business. It is just to recruit people and recruit in the branches which are there on the vehicle finance. So in a way, it will actually leverage on our existing branch network, and it will improve the utilization of the branches. So from there, we don't have any problem. The people cost only going to be one cost, and second is the OpEx of using the loan origination system or loan management system or loan collection system of the technology partner which we are going to use it. So it will be in line with the business. It will not be a very humongous cost.
Got it. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of Harsha from L&T Mutual Fund. Please go ahead.
Yeah, thank you. I just have 2 questions. Firstly, on that stage-wise ECL summary slide of yours, between 1A and 1B, you have written that 1A is normalized and 1B is yet to be normalized. So can you just help me understand what do you mean, or what do you define? How do you define normalized?
Yeah, this is Arul here. Normalized is what we mean is that it becomes zero, but that is all dues have been repaid. So as per the RBI norms, you will have to collect everything due from them with regard to the EMI and principal by the before you can reclassify them as a non-NPA or a standard asset. So I'm trying to follow the same thing in the ECL model or under the Ind AS also by classifying them basis the under ECL model, you have to classify based on number of days. So stage 1 is less than 30 days, and stage 2 is 30 to 90 days, and stage 3 is 90 plus. So which is the assets which have touched 90 and have moved back to stage 1 and become completely normalized, that gets classified as stage 1A. Stage 1B is those which have gone to 90 but have moved back but have still not yet come to completely zero. That is they have not yet completely extinguished all their overdues. Then they are classified as stage 1B. So 1B under the new norms is an NPA. 1A is not an NPA.
So just to follow up on that, if let's say in 1A the account was 90 days plus, you have recovered some dues, and it has moved back to stage 1. But if as per RBI you have recovered each and every penny from that account, then how it still continues to remain under stage 1 or 2? It should be a fully normalized account, right? Assuming you recovered every penny.
No, between the time it became an NPA and now, there are further EMIs falling due. All that also got to get recovered.
Okay, so 1A is basically that has moved back from 90 days to stage 1, but has also cleared all its dues. Whereas in 1B, it is also moved back from 90 days to stage 1, but it is not cleared all the dues.
Yes. What we are doing is 1A is still perceived as slightly more riskier because he has touched NPA and come back. 1B is those who have touched NPA and come back, but not yet cleared as per RBI.
So, sorry, can you repeat this line, sir?
So 1A is those who have touched NPA and come back. So they are perceived as slightly more riskier than the pure one who have never gone to NPA at all.
Oh, yes, agreed. Okay.
That is the distinction we are trying to bring, and that is why you see the provision percentage also slightly higher for each of these categories.
Understood. And second question I have is, we have seen in a generalized economic trend right now, we have seen cost of funds more or less stabilized, whereas for Chola, the cost of fund has also declined very sharply this quarter. So just a two subsects on this question. Number one is your cost of funds you can leverage further on the yields and eventual NIM to existing business to drive NIMs from here. And secondly, in this new businesses verticals that we will grow over the next few years, how those NIMs of those businesses will be as compared to the existing business?
See, what we do is we don't play with the price to boost our disbursements or otherwise. It is more done from an underwriting principle to see that we lend to people who could, pay back in time. So the price is secondary. I'm not saying it is unimportant, but it is secondary. So the price will not be the determining factor. So the NIM is the cost of funds reduction need not necessarily always be passed on. Sometimes it is passed on, sometimes it is held back. So we are in a situation where we are right now holding back. At some point when we see movement, we may pass it off to on the yield benefit, but that will be more market determined. The second question on the new businesses, it is evolving. We need to see, but I am sure there the NIM levels are very high, but there you will also have on the flip side more OPEX and slightly higher credit costs. So overall ROTA will be better than our traditional businesses, but it will have differential NIMs and differential OPEX and the credit costs.
Understood, sir. That was perfect, sir. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Prashant Sridhar from SBI Mutual Fund. Before that, I would like to remind all participants again to please limit your question to one per participant only. Over to you, sir.
Hi, sorry, am I audible?
Yes, now you are audible.
Thanks for taking my question, sir. Sir, you were just talking about some type of flexi loans on the business side. The general confusion we have is when the customer does not have to pay a principal every month, how do you figure out the repayment trends and credit costs, and how does that differ from a normal term loan to the same SME, or is there a difference? Just that one question.
No, in the flexi loan, there are two types of flexi loan. Okay. One is a simple flexi loan wherein you can actually give the opportunity to customer to pay only interest, and at the end the customer can pay the bullet. We are talking about the OD drop line flexi, wherein every month the OD limit will keep coming down. So to that extent, customer has to repay that principal. So the interest also will be served, and this. In fact, in the market, there is a hybrid flexi loan is also there, wherein for 2 years Suppose there is a total tenure of 5 years, so 2 years it is simple. That means only customer will serve the interest, and then after that drop line will start. So we are focusing more on the drop line flexi loan, and simple flexi loan we are not at all encouraging as of now. That is the reason what you mentioned about it. And hybrid flexi loan we have not launched so far.
Sure. Sure. So, just one follow-up. How do you would have done some study on the credit costs for these flexi loans, right? Drop line or hybrid, whatever. How is that different from normal credit costs to the SME sector? What should we sort of expect when we compare it with that?
So there are different players, and the mix of the drop line versus term loans are varying, because term loan, the ROA or ROTA is lower. And the drop line flexi is basically is like, from the vehicle finance point of view, it is new and used. Okay. So in the used, what we have, higher NCL and higher it is a high risk, high reward type. It depends on how best you do the collection. So there are players like some who are doing very good collection, and therefore they have a higher NCL, but they are able to manage it within the threshold, and they are able to deliver higher ROTA. So in the case of the drop line flexi as compared to term loan, it will be higher, slightly the yield will be high, and it will be NCL will be high. At the end, the ROA will be high.
Got it. Sure, sir. Thank you so much. That's it from my side.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yes, thank you so much for taking my questions. And sir, I understand you've been asked to restrict us to 2 questions, but apologies, I have 3 questions, one each for Vellayan, Ravi, and Arul sir. Sir, Vellayan sir, firstly, I think, if I heard you right, that we're looking to partner with 10 fintechs. So just wanted to understand that there are so many other NBFCs who would have entered into such co-origination and co-lending partnerships with fintechs. So are these partnerships exclusive in nature? And just if I might ask, we already have done a JV with DBS in the past where the experience was not good. So what will be the right to win in these newer ecosystems and product segments? Have you already done hirings for these newer segments? Who will be leading this newer ecosystems and products? And sir, lastly, what measures have you taken to ensure that this time around there are no lapses? Like we had about a decade back when we entered consumer loans.
Yeah. Okay. So first, in terms of you're right that these. So first off, I think we should understand that the nature of what happened with DBS and what is happening now is very different, right? In that case, DBS came in and played a very significant role in the management of the company day to day, right? Here, in the case of these partnerships, it's still very much kind of Chola culture, and honestly, I think kind of one of the big reasons why DBS failed, kind of the relationship with DBS failed, is because we had 2 different cultures under the same roof, right? Kind of the classic NBFC culture, which is what Chola came from and is very different from kind of, what I would call a DBS, which is much more a bank-led culture, right? Also, when they were approaching it then, we got to recognize that there was no data available on Indian consumers, right? There was no CIBIL, or CIBIL was at a very, very early stages. And pretty much all of the data we used to submit to CIBIL, we didn't actually kind of get any information from any of the credit rating agencies. So first off, India was a very different point then, right? So I think that's the first thing. The second is, like I said, the role of DBS as a partner was different, where they were involved in the management, right? Here, the role is totally different because it's Chola managing with our culture, with our way of approaching things, with our underwriting capabilities, where we're basically using partners like this who can help on origination, right? So if you talk about the Bank Bazaar and Paytail, for example, there right now we're pretty much the the primary partner. Bank Bazaar is kind of partner with somebody else on the card side, but in terms of this product that we're going after, we're the only partner initially. And also the format of, the structure is different from kind of the classic kind of FLDG format. It's actually structured as a co-sharing relationship, right? The loan still sits on our balance sheet, but basically it's a very different structure from an FLDG structure. And so your question on kind of why are we taking this up, so there are two questions, I think, kind of, why is this approach different from DBS? Hopefully I've answered that. Second is, why do we need to partner with these fintechs? Honestly, the way I look at it right now is, we see it as kind of as a different mode of acquisition, right? Basically, I think gone are the times where only one mode of acquisition will work. And so whilst we have the core business and the core underwriting skills, hosted under a key person, for that person, there's a traditional mode of origination that he or she is managing. And in addition, we're also trying these digital modes. So like I said, we're going to be cautious and only scale the modes that we believe are scalable. And that's always been Chola's approach, and that will continue to be Chola's approach now. Your question in terms of why will we not fail like we failed last time? I don't know. I think I'm paraphrasing it. Maybe kind of it was asked in a different way. Obviously, I think it's the approach, right? Basically, right now, even on these loans, we're predominantly still looking at it. Our whole mindset at Chola is first is collections, second underwriting, third origination, right? So we still are looking at, hey, will we be able to collect on these loans? How will we be able to collect if there's non-performance? And then looking at underwriting standards, where we now have a lot more access to data on these customers than we did before. The last time we did consumer loans, we had very little data, and therefore it was a very different approach at that point in time. So I don't know if that answers your question on that.
Yes, sir, that does. And so lastly, have you already done the hiring for these newer segments, and who will be leading these segments?
Yeah, so we've done the hiring. Ravi, do you want to? Sorry, yeah, I think, okay, and so Ravi, maybe you just answer this and then we can move on to the next one. In terms of, I think the question is who's leading the segments? Arul and Ravi, have we shared kind of who's leading the segments in the past?
No, we have not shared. So all three businesses are being now headed by the people who have worked in Chola for many years. And after that, the people who have been working in this industry, and they have been hired from the market. And the hiring is going on as of now. But the business heads are all those three business heads from the Chola who are working in Chola for many years, more than 15 years.
So I think that should give you comfort that each of the business heads have been in the company for over 15 years.
Sure, sir. So if you allow me, can I squeeze in one last question here?
I think it'll be better if you come back in. I think because
Sure, sir. Thank you so much, sir, and wish you the very best.
The next question is from the line of Abhinav Anchal from SBI Life Insurance. Please go ahead.
Hi, sir. So I have a couple of questions. One, can you throw some light on the...
I'm so sorry to interrupt, but your audio is not clearly audible.
Hello?
Yeah, good.
Yeah, am I audible now?
Yes.
So, sir, I have a couple of questions. First, can you throw some light on the collection trends in the January? And how do you see this 2B bucket moving forward? Do you think it is going to normalize in subsequent quarters, or this is the natural outcome of our business model? And the second one is that our net NPA is currently very close to that 6% threshold target. So what's our thought process on net NPA? And do you think collection alone can drive it, will, let's say, take it to a safer number of around 4%, or we have to make some additional provisions also?
Yeah. So this is Ravi Kundur. So I'll just talk about the collection efficiency and vehicle finance, and this is almost similar in rest of the two businesses also. And since the portfolio of vehicle finance is 70% of the overall portfolio, it matters most actually. So in the vehicle finance, we have seen the highest efficiency in terms of cash flow against the billing, and which has gone up to 123% in December. In October and November, it was 116%. In January also, we closed 123% against the billing. In terms of collection efficiency of the non-delinquent book, in the month of October and November, it was more than 98%, 98.5. In the month of December, it reached to 99%. So roll forward was 1.07%. In the month of January, again 99%, but the roll forward was 1.13%. So the collections have improved and it is significantly better than the past, and it has reached to the level where we used to do it in the past. Now coming to the NPA, at Chola's level, we are at 5.85 in terms of Ind AS, and as for the RBI, it is 8.53. In this quarter, I think we will try to reduce it by 2% over and above RBI, whatever we are at. And if you take the net NPA, so net NPA from 5.75, it can go down to 4% level within say 6 month time. And I'm just trying to keep 3 more months extra. But we are moving in the direction. So already improvement has started seeing in the month of January as against the December. It's just a matter of 6 month time, because this is the new RBI now, wherein the ever 90 customer who were basically touching 90 and being there in the stage 2 for longer period, and which has gone up during last 6 months post wave 1. That will be taken care, because we will go to the customer to educate them and try to basically collect money from them, because it is kind of their bureau score is getting impacted, and their loan, if they want to take a loan, that will also get impacted. So by that we can actually customer who are in the bottom low hanging fruit, like those who are in stage 1 and then stage 2 customer.
Thank you, sir.
Thank you. The next question is from the line of Mahrukh Adjania from Edelweiss. Please go ahead.
Yeah, hi. This question was asked, the previous person also asked this question. So the other transport financiers want to move to 4% NPA, net NPA. Is there any such plan for you?
Arul, you can.
Yeah, so the need by some of the other players who have to move to 4% is because of the dividend policy announced by RBI, where if they had crossed the 6% NPA in the past, in the current year, unless they become 4%, they cannot, declare dividend. That is why the threshold of 4% is being, targeted by them. Not that we don't want to go down to the 4% level, but in our case, since we have never touched a 6% NPA in our, in the last 3 years, we are not constrained by that regulation to declare dividend, even if we are above 4%, as long as we are below 6%. So we are below 6%, and we will certainly be driving it to bring it down to 4%. But that constraint of having to necessarily touch 4 is not a mandatory or a regulatory requirement as we speak today.
Got it. And what will be your outlook on margins, given that bond yields are firming up? So your bank borrowings, the reset on bank borrowings is what? 1 year, 6 months?
It all is different for different borrowings. We have borrowings which have got a 3-month reset, 6-month reset, 1 year reset. We have borrowings linked to various benchmarked, indexes like your repo or treasury bill, etc. And some of them we have also hedged against, these by having a fixed to floating to fixed sort of an arrangement. So it's not like, we can't, if we don't have one single mode. It's a mix, and we do it and we manage it depending on what we see as the outlook for the coming period.
Thank you. The next question is from the line of Piran Engineer from CLSA. Please go ahead.
Yeah, hi. Some of my questions have been answered. Just on the previous question itself, just wanted to understand that during COVID we got bank sanctions at pretty low rates by linking to external benchmarks, and now that priority sector thing has gone, how do we see this repricing upwards next year? And just the other clarification to Kundu sir's thing about 600-700 crores of quarterly disbursement from the new business, the runoff of this business will also be pretty high, right? Is that a fair assumption? So that's it from my end.
Okay, I'll take the first question, Arul here. So we will see repricing when we have a MCLR repricing happening in case of bank loans. And in some of the cases, what we have done is we have moved away from MCLR into benchmark currency even for bank loans. And today, banks are offering benchmarked, indices very fairly low rates, even for non-PSL assets. Earlier, they were only restricting it to PSL assets. Now, today, they are offering because banks are also in need to grow their book. So we are capitalizing on that. We have repriced a lot of our loans during Q3, which is where you see a further improvement in cost of funds in Q3. We see that continuing for some more time. Yes, at some point the trend will change, and at that point in time we have to take necessary actions to protect our NIM, and we will be doing so.
Thank you. The next question is from the line of Subramaniam Iyer from Morgan Stanley. Please go ahead.
Thanks for the opportunity. My question has already been answered. Wish you all the best.
Thank you.
Thank you. The next question is from the line of Aditya Jain from Citigroup. Please go ahead.
Thank you. If you would talk about a little bit about the fintech partnership. If Credit B, say for example, has multiple NBFC partners, how does the allocation that happens to Chola work, and where does your underwriting model feature into the process? How automated is it? If you could give some color along those lines.
Yeah. So the allocation is based on the underwriting norm decided and the commercials discussed. So therefore, that is one. And underwriting is fairly automated. Nothing has to be done manually. We need to cross-check and see that if in case there is a problem, we can recalibrate time to time, which we have opportunity to do it every month. In terms of their other partners, they are preferring us because we have a huge network, and in case of there is a fallback, we can support them in collection. So the branch network, collection efficiency, and collection strength of the companies are preferred more than anything. And definitely there is a bit of underwriting norm, and commercials are also important. So commercial is the starting point, but the ending point is how we can support them in order to basically serve their customers in a larger way. And they see that Chola is one of the largest players in the market in terms of network and having a very robust collection mechanism which can support them.
All right. Thank you.
Thank you. The next question is from the line of Harshvardhan Agarwal from IDFC AMC. Please go ahead.
Hi sir, thanks for the opportunity. Just two very quick questions. One is the restructured book number that we gave. Does it have any overlap with the stage 2B book?
Shyam, do you have that data? I got to check that out. I am not. There will be some maybe, but it will be very minuscule because it would not have had the time to move to 90 and come back, so that would not be the case at least for now.
Okay, sure. And one last thing is, like, during the start of the year, we typically guided that we intend to take our stage 2 plus stage 3 back to 10% by the end of this fiscal. So do we still expect that stage 2 plus stage 3 to come down to 10 for next quarter?
See, to some extent, because the restructured book will continue to be in stage 2, irrespective of whether they are in zero bucket or otherwise, the stage 2 will look inflated because, unlike the earlier restructuring norms where RBI allowed us to reverse back from a NPA status which was assigned to the restructured book after 1 year. In the case of the new norm, they have asked us to hold it as restructured and carry a additional provision for a period until 50% of the loan is repaid. So until then, we can't reverse this back into stage 1. If as we have opted to keep it in stage 2 because of the higher provision, etc. So till that time, we will continue to keep it in stage 2. And as and when they reach the 50% threshold, then we will move them to stage 1. So it may take a little longer time, but that does not mean that the book is bad. That's what I'm trying to convey.
Thank you.
And it has come to 10.37 now already.
Yeah.
Thank you, sir. The next question is from the line of Shweta Dattardar from Elara Capital. Please go ahead.
Thank you, sir, for the opportunity. So my question is pertaining to home equity GNPA. So they have been sticky for some time now, whereas things are actually picking up on the growth traction front. Also, how is it panning out in terms of SARFAESI resolution? Could you throw some light there?
Suresh, we can't hear you properly.
Sir, can you hear me now?
Yeah. That's
yeah.
So our stage 2 and stage 3 from quarter on quarter, we both stage 2 and stage 3 coming down. And we see a lot of traction happening on the SARFAESI side now because the DRTs as well as the court started issuing orders. We still see, some of the orders now coming from the DRTs, but we expect that things will ease out now with most of the lockdowns have been released now. So we see it will be only improving from this point onwards. Hello, I hope. Hello.
Yeah, we could hear that.
Yeah.
Thank you.
Thank you. Ladies and gentlemen, the next question is from the line of Nischint Chawathe from Kotak Securities. Over to you, sir.
Yeah, hi. No, this was just probably this just got slipped off. But there was one question that in the new businesses, while disbursements would be high, your rundown probably also remains high, right? Because some of these would be short tenure loans. Maybe if you could just comment on that.
Yeah, Nischint. So the mix of the small tenor and longer tenor is as similar to vehicle finance as of now. In fact, small tenor is very less. So the rundown will be also similar to vehicle finance. It will not be aggressive.
Sure, perfect. That was the last question. Thank you everybody for joining us today, and thank you very much. Thank you very much to the management for giving us an opportunity to work.
Thank you.
Thank you, Nischint.
Thank you, Nischint. Thank you all.
Thank you, everyone.
Thank you.
Thank you. On behalf of Kotak Securities, that concludes this conference. Thank you all for joining. You may now disconnect your lines.